You're listening to a news summary from PolicyDeck.News. Pakistan has completed the long-delayed privatization of its national airline, Pakistan International Airlines (PIA), selling a 75% stake for 135 billion Pakistani rupees, $450 million, to a local consortium led by the Arif Habib Group. The government has described the deal as transparent and reform-driven, but critics say it reflects deep fiscal distress, weak investor confidence, and a shift of strategic assets toward domestic, often military-linked capital. The state has retained a 25% stake, while the buyer holds an option to acquire the remainder within a year. No international airline or foreign strategic investor participated in the bidding. Founded in 1955, PIA was once a leading Asian carrier and remained profitable through most of the 1960s, 1970s, and 1980s. Analysts and former executives trace its structural decline to the early 1990s, when successive governments began using the airline for political hiring, allocating routes based on patronage rather than profitability, and imposing price controls that distorted commercial decision-making. By the late 1990s, public audit records show PIA had become chronically loss-making and dependent on government bailouts. In the mid-1980s, PIA operated around 45 to 50 aircraft with about 18,000 to 20,000 employees, broadly in line with global norms. After 1989, staffing rose sharply without corresponding fleet expansion. By the late 1990s, PIA employed more than 30,000 staff, pushing employee-to-aircraft ratios far above international benchmarks. Large-scale political hiring slowed after the 1999 military takeover, but was not reversed, as governments avoided layoffs due to political and social resistance. The most damaging phase came after 2008, under successive PPP and PMLN governments. Employee numbers peaked between 45,000 and 50,000, while operational aircraft fell below 35, many grounded for maintenance. The employee-to-aircraft ratio exceeded 1,000 to 1, compared with a global norm of 150 to 250. Aviation experts say no airline can survive with such a cost structure. Losses mounted into the hundreds of billions of rupees and were largely absorbed by the state through guarantees and bailouts. Debate has also focused on valuation. PIA lists 34 to 38 aircraft, though only 18 to 20 are operational. Based on current secondary market prices, analysts estimate the operational fleet alone could be worth $350 to $500 million, excluding landing slots, bilateral air service rights with more than 90 countries, brand value, and ground infrastructure. This has raised questions over whether the $450 million sale price fully reflects the airline's underlying assets, even after excluding hotels and real estate retained by the state. Government messaging on the absence of foreign bidders has been inconsistent. Some officials cite regulatory complexity and PIA's loss history, while Defense Minister Khawaja Asif said the privatization reflected rising foreign confidence, a claim contradicted by the all-domestic bidding. Independent analysts point instead to political instability after Pakistan's regime change, weak rule of law enforcement, currency volatility, and opaque civil-military decision-making. These deals don't fail on valuation alone. They fail on trust, said a Karachi-based investment banker. Comparisons with Air India's privatization underscore the controversy. Air India's sale to the Tata Group involved competitive bidding, meaningful risk transfer, and assumption of significant liabilities by the buyer. By contrast, PIA's deal largely ring-fences historical debt and pension obligations with the state, offering limited immediate fiscal relief. As Pakistan remains under IMF stabilization